Hello, everyone, and welcome to Money Mondays with Marcus. Just thought I'd give a bit of background about myself. I'm been a Centrelink man for about 20 years, and I come across to finance for the last seven, and been working with Complete Wealth for the last five. So, uh, what we thought was we'd bring up some topics that we're going to discuss that just to get some experts in, and things that are in the news every week, and just try and discuss them and expand them a bit. So today we're going to talk about things, investment performance, which is a topic that everybody goes through with their different investments. And, you go and see an advisor and they talk about last 6 months, last 12 months, last 3 months. But we're going to draw into that a lot more. So today I'm going to introduce Matt Buddy. He's the CEO of Complete Wealth. Matt's a bit of a math geek who loves talking about this stuff. So welcome, Matt.
Hey Marcus, how you doing?
Good, mate. So we thought it'd be a good idea to get you in and just expand on, the word performance is something we all think we know, but there's a lot more to it, isn't there?
Yeah, there certainly is, absolutely. Yep.
So in simple terms, the higher the return, the more money you have. So isn't getting the best return that all that matters? So I know one of our key investment principles is returns matter. Obviously, you don't want to lose it all, but the holy grail is high returns with low risk. But that's not that simple, is it, Matt? Those.
No, yeah. So look,
Um,
returns do matter. That's absolutely sure. But I guess the question is, what are you actually talking about?
yeah. So how do you actually go about achieving good returns, and how do things like performance tables and the research we give everybody, and um, le, APRA's new league tables for super funds? I think they've got a top 10, haven't they? Now the government's putting out, but what are they talking about there? And is that just performance, or is that based on past history, or what they're estimating going forward? How do you make sure the risk is low or reasonable or suits every client? And how do you compare just apples with apples out there? Like, there's a lot of information for people out there, and I think just to draw on it a bit more, like performance. What is performance?
Yeah. Okay. So yeah, look, absolutely returns matter because from a purely mathematical point of view, the return you get determines, I guess, how hard your money sort of ends up working, right? But I think there's sort of two extremes to that I think it's worthwhile sort of starting with because both those different extremes are sort of myths that I think need kind of busting, right? So they both look at the sort of risk-return relationship in sort of different ways. But they're both, I think, wrong in their understanding, and therefore they can lead to some pretty important mistakes, right? So the first one is what I'd call the risk of taking too little risk. And we see this in particular with retirees. So, it's based on the concept of saying, I've sort of made my financial capital now, and I don't want to put it at risk because it's, I don't have the time now to sort of make it back again, sort of thing. And that comes from a sort of, like most things, come from a sort of correct assumption in that our financial capital really is largely built out of, the deployment of our human capital and that excess cash flow being sort of pumped into to grow some investment capital. So, and the mistake it assumes though is that human capital is somehow infinitely interchangeable for financial capital. In other words, if mistakes are made, it's okay because as long as you've got time to keep deploying your human capital to make it up, then that's okay. And that's not necessarily entirely untrue. You can keep, and in some cases you may have to keep working. But it's sort of, it's in reality, I'd argue probably the opposite is true, is if you make mistakes when you're young, you've got the rest of your life to pay for them. Whereas if the older you are, the less time you've got to live with that mistake, if you like. So, and so probably the best way to look at that is what happens to those returns over time. So let me just bring this one up.
So can you just expand on what the risk, sort of what you mean by risk?
Yeah, so
in
risk,
the investment sense.
the most important definition of risk, I think, is not volatility, which is what the finance industry and most people sort of talk about, and we'll talk about why that's not a good measure, as we go through some later examples. But risk really is the likelihood of not achieving your goal.
Yes.
Okay, so it's probabilistic, obviously, but you really got to think about risk and risk in total as the sum of all the risks, sum of all the little probabilities, if you like, that
Yeah.
interact. They don't necessarily add up. Some, some add up, some subtract, some multiply. But how do those risks interact? So if you think of it, the sum of the risks, how do they interact to form the total risk? And that total risk is relative to your goal. So if your goal is to keep the market price of your portfolio stable, for example, well then anything
Yeah.
that has a degree of volatility will be very high risk. But if
To you, yeah.
because of the goal, right? And
Yeah.
there's circumstances where that is a viable definition, but there are other circumstances where that's not. If your goal is, for example, to generate the highest possible long-term average return, which, i.e. make your money work as hard as possible over your lifetime, well then, investing in anything that doesn't have the probability of high long-term returns, things with high guarantees or high price stability, they most definitely will not achieve that. They're going to be in the bucket of things that absolutely aren't going to be the highest performing long-term assets. And so in that definition, that'd be extremely risky. So again, risk is it's always a very relative measure. And there's no better example of that, I think, than when people get towards retirement, they think, okay, I've got my financial capital, I need to preserve the value of that capital. Now that's true, but I'd argue that's even more true, and we'll look at the impact of that on young people in a second. But the downside or danger of what I would call not taking enough risk in retirement, and that is looking too conservative in terms of your pricing volatility, which automatically reduces your prospect of return. We see from this graph in a really simple sense, your average return matters. In this case, we just sort of drawing $75,000 a year out of a portfolio of $1 million. And we say, okay, well, if we earn 5% return, it runs out a lot quicker than if we earn 8% return. Right? Yeah. There's no rocket science in that, just sort of straight mathematics. So our long-term average return really matters. And if we're retiring at sort of 65 and we've got a life expectancy of sort of 85 plus, okay, and especially for a couple, that's life expectancy is the average. So people living well into their hundreds, for example.
Yeah.
So you are really talking long term, and a lot of people think that as you retire, or even as you're going through retirement, well, I don't have a very long term now. And the truth is, unless you're in your 80s, there's a reasonable likelihood you've got 20 years left to live in most cases, and particularly if we're talking about a couple, that at least one of those people are. So we need to be really mindful of what the risk is that is relative to the goal we're trying to achieve. So one of the things we don't want to do when we get to retirement is we don't want to be in a situation where we don't invest for the long term in the misguided assumption that we no longer have a long term. Because hopefully
So there was a
most people
time
do.
when I first entered the finance industry, like AMP, One Path, they had cycles. So if you were born in the 60s, they automatically changed you down the 60s, like the younger you were, the higher risk, and as you got older, it automatically changed you. So have they gone away from that style of
No, that
investing?
sort of life stages, if you like, that's actually really common now in my super products and a lot of industry funds and a lot of, let's say, collectively unadvised money, is what I say. And look, it's not a bad idea in the sense that as you get closer to retirement, your risks change. So, for example, one of the key things we often talk to clients about in retirement is a thing called sequencing risk, right? And that's the timing of your returns. And I won't go into that in a lot of detail because we've looked at that in other videos. But it's really important to appreciate that in reality, if you have a large amount of capital, putting that long-term capital fundamentally at risk, I would argue, is always a bad idea. And we'll look at particularly that when we look at the example for young people. But putting financial capital and exposing it to volatility is not risk. Okay, and we'll look at some examples of demonstrating that. But unfortunately, more often than that's what people perceive it to be. And that's one of the reasons why we wanted to delve into performance today, is so we can really look at performance or how it's often measured or portrayed, so that we can say, okay, well, what is performance really, and the performance that we want to get, essentially, what is that and what's that look like in the long term? I just want to point to this graph as well, because I think it's a really important thing to appreciate. It again is because financial capital is accumulated, and it's not accumulated linearly, it's a logarithmic, if you like. So most happens, at one end. Your 80% of your total investment earnings happen after you reach age 55, right? And that's just because of pure weight of capital. So
Yeah,
again,
it builds
the
up.
time you don't want to be conservative, and that is deliberately target lower long-term returns, is when you've got most of your money at play, because clearly you're going to get the worst sort of overall result. And obviously the other end of that is people say, okay, well, it's okay for young people because young people have got plenty of time to sort of make that up, right? And again, that gets back to that concept of saying, okay, well, that's because my financial capital is a result of surplus human capital that I'm able to add to that. And if I'm young, I've got all this extra time that I can work. And again, whilst that seems to some degree logical, and it's at least the most amount of flexibility at that point, the reality is we still all want to work a reasonably constrained period of time. And in fact, at least if you've made it to sort of 55, 60 and you have accumulated what you have, you've at least made that. Whereas, many people die or have severe illnesses or injuries or other impacts in their life circumstances, even not just themselves but other family members. So there's lots of things that could impact your ability to accumulate that capital even in a normal life. That means you might not get anywhere near that one point. So taking extra risk, if you like, in terms of actually putting your capital at risk, the penalties for that for young people, I'd argue, certainly mathematically, are more extreme. And we can see that when we look at, we just look at a couple of graphs and we say, okay, well, if we're a young person and we've got one option, we can invest in a sensible, normal way, and we compound over time. So 2 becomes 4, 4 becomes 8, and we continue to build our capital over time. But if we go down the sort of like, okay, well, instead of doing that, we start to speculate and say, okay, well, and we get something wrong. And so instead of doubling our money, we end up halving it over a period of time because we've gone into something speculative, it hasn't worked out, and we've blown up sort of half our money. Well, I guess mathematically people look at that and say, okay, well, because there wasn't a lot of money at play and we've got a long time left, we got time to make that up again. But the problem with that is it ignores what happens from a compounding aspect then on. And we can see that in terms of this graph here, the blue versus the orange line. And you can see the recovery line, once you go back into that starting from scratch again investing, we kind of miss the first cycle because we were halving when we should have doubled. And then the next cycle really only gets us back to where we started from, right? Because returns are asymmetric on that there's more downside loss than there is upside gain for the same percentage return, right? So you can see here is what that happens is we end up with an increasing cost over time. So instead of being at the blue line, we're only at the orange line in terms of wealth accumulation. And that cost gets bigger and bigger over time. And we can see that if we look in terms of numbers, instead of going from 2 to 4 to 8, we go from 2 to 4 to 2. And now we're a factor behind for the entire rest of our lives on that capital, right? So, we might get sort of, 30, 40 years down the track, year 36, just using this example, starting with 2000, instead of having 32,000 in 36 years' time, we should have 128. So it's a sort of factor of 4, right? And we're never going to make that gap up, right? Because of the mistake we made early on. So does that make sense?
Yeah. It's sort of, I heard a saying, well, I'm not sure if it was you, but if your investment goes down 50% too speculative, like you said, it's got to go up 100% for you to break even.
Correct, yeah. So then we call that the asymmetry of returns. There's a video we've done on that specifically people can check out. It's one of our investment principles is to appreciate that. And so it's important also to recognise what we're talking about here. We're not talking about volatility in price, and we'll talk about that in a bit of detail in a moment, but we're talking about generally putting capital at risk. And so what I'm not saying that therefore one shouldn't take any risk. What I'm saying is you need to be really mindful of where and how you take that risk, right? Keeping in mind that when you're young, the rate at which you're depleting your human capital, your earning capacity, if you like, it's actually really small. Okay, so mistakes you make then, they're relatively big. They take quite a while to overcome because just there's so many things competing for your resources when you're young, and you've got so little realization of financial capital, if you like. Whereas when you're older and you're more productive, there's probably you've got some financial capital. If you've had kids
Are growing
up, those sort of things. So resource allocation is much more malleable later in life as well. And not only that, your ability to potentially extend at a very high rate as well. So it's important to appreciate that as you're older, you really want to make sure that your money continues to work as hard as possible, that it's going to give you the most it can. But also really, really important when you're young is that the cost of that compounding over long term generally dwarfs everything else. So looking after it's really, really important, making good decisions.
Rightio. So what you're saying is that everybody should be aiming to maximise risk-adjusted returns throughout their life, not punt when young and term deposit when old. That's the common theory we hear out there: is high growth young, more conservative as you age.
Yeah, so look, yeah, so as I said before, I think it's more a case of understanding the way that your overall risk appetite, changes. So
Yeah.
one of the advantages of experimenting, if you like, with your risk appetite when you're young, is you do have the advantage of changing the lifestyle that you're willing to accept,
Yeah.
right? You might be willing to pursue a higher lifestyle because, one of the things I like to tell people is, in fact, it's actually really easy to make more money. You just have to do the things that make more money. So, the amount of money you generate is limited by what you're willing to do with your human capital, right? So if you want to earn more money, do a more dangerous job, work more hours, sacrifice more personal life. There's always a way to generate more money, right? The question is, are you willing to do that, and how does it change your overall risk appetite and your risk bucket, if you like? Because that's relative to what do you want to achieve, what do you want to get out of life, right? So, but investing or what we call growing money, is really the deployment of financial capital in a passive sense. There's a very, very limited range of returns you can realistically hope to generate out of that, right? So if you want to make a lot of money, then you have to do the things that make money. You have to trade things, inputs and sell them at a greater value. So that's why we call it making money, and that will always make more money. But that's what human capital is for, right? That's deploying in a business or in trading in some way. What you don't want to be doing is you don't want to be growing your financial capital by trading it, if that makes sense. You're either in the business of trading financial assets, and in that case you're making money. The fact that you're using the same instruments someone else might use to grow their financial capital, that's where people, I think, make the mistake. So you're either in the business of trading something, even if it's shares, for example, or you're in the business of growing something, and they're two fundamentally different things. So deciding...
Can't you do both at once?
So you can do both. You can do both at once, in a sense. You could use the same types of instruments to do both. So, for example, you could be, if you're a share trader, you might be trading shares as your way of making money. You're in the business of trading shares, and you might be saying, okay, well, over time, I want to accumulate some, passive, financial capital. So in that sense, I'm going to grow that. I'm going to put that money, deploy that money somewhere else in a way that generate that income, that cash flow that I'll need. But they're two fundamentally separate things. The fact that you might be using the same thing, same instrument, if you're trying to do them both the same way, or if you're trying to invest by trading, or you're trying to trade by invest, it won't work. Okay, so that's a really important thing to appreciate, is that how you take risk in your human capital and how you take risk in your financial capital, those two things come together to help form that total risk bucket. Now, one of the classic examples we often see with a number of clients who are farmers, for example, is how farmers don't like to take a lot of risk, right? Which I personally find crazy, because I don't know when it's going to rain, right?
And they are taking risk, but they don't class it as risk.
But what they mean by that, right, is a good farmer. He's managing all the risk, or she's managing all the risks he or she can in relation to the way they operate that enterprise, with the constraints that they have. But because of the variability in that, and because of their lack of control over many of those aspects, when it comes to their financial capital, they don't want to be trading that. They don't want to be putting that at risk in a way to say, I'm making money over here, and then I'm going to try and make money over here as well, and hope that they both pay off.
So an example of that would be recently in the last 10 years with the drought, the government offered them the farm management deposit. So people weren't willing to risk their cash, their surplus cash, but they'll put it in a deposit.
Sure, but even without other sources of income, etc., I would argue that if the way you make your money, or even the way you earn your money, for example, is relatively at risk, because you're a very high executive, or you're highly specialised, or whatever it is, to whatever degree your human capital, it's like all high performance things. There's limited ability to stay at the top of high performance, whatever that venture may be, whether it's athletics or academics or business, right? So to a degree, if you're trying to do that, you need to match that risk, with what you're doing from a financial capital perspective, right? And
Yeah.
again, I don't mean this for anybody. I don't mean, therefore, if you're a public servant, or you're a university professor with tenure, or you've got guaranteed income for the rest of your life, essentially because of the industry or your work environment. It doesn't mean that you can then go speculating your financial capital on the side, because that human capital is 100% going to run out at some point in time.
Yeah.
Or there's always a possibility, because of things outside your control, illness, injury, even different life circumstances from people close to you, that could substantially interrupt that. So when we talk about financial capital, we're never talking about putting the long-term value of that, or because keep in mind, it's important to appreciate that the reason we have financial capital isn't for any purpose other than to give us future purchasing power for the real assets that we need. Okay, we
Yeah.
need somewhere to live, we need to be able to eat, we need to be able to get by day to day. That needs to be paid for with something other than our sweat and effort, right? So in the future, we want to exchange our financial capital, be that income, capital, some form of cash flow.
Yeah.
We want to exchange those for those real assets, okay? And our financial capital is there to help try and protect and to some degree enhance that future purchasing power. That's really what it's for. And if it's there to do that, we're going to be really, really careful about deploying it in a way where that might not happen.
Yeah.
Okay. So that's really kind of what we're talking about. So the way we take risk with our human capital and give ourselves the ability to generate as much money as possible is an entirely different thing, but should be considered in relation to, what we're also doing with our financial capital.
Alrighty. So, let's have a look at investing now. What about, I'd like to talk about performance, because it's big on definitions. Everyone's talking, I got 10, you watch the industry super funds on the tally, and 9.7% return for the last 10 years. But then also, how do you go about analysing it to determine what investments you think are likely to perform, and how do we assess performance? So, how do you use graphs and tables and research material and all the different things that are available out there? And who do you believe? Is everyone, that's the thing. I think there's so much info out there, and we just get flooded with stuff. And yeah, you'll hear one side of it. They say, yeah, this, and then say, no, that they didn't do that. So yeah, it's.
Yeah. So look, like a lot of things, one of my favourite answers, if not my only answer, is it depends. So look. And look, you know me, I like to get down to the specifics and why definitions are so important. Because, look, as a general rule, we don't use performance graphs and tables pretty much at all. Not the performance tables and the sort of long-term graphs that you generally see. I'd put them really into the category of marketing material as opposed to research. And I'll give some examples of why that's the case. Because more often than not, they're an example of what I call using the truth to tell lies. So one of the things that I suppose, math geeks like myself like to really kind of hone in on is what's the purpose of a measurement? Because a lot of people think data is truth. And while it's true that data accurately obtained is an accurate representation of what it measured, that doesn't necessarily mean that data is always, can be used in any way, shape or form. One of my favorite quotes is, if you torture a statistic long enough, you can get it to say anything. So let's start with definition and be very clear about what we mean by performance and how it's measured. Because without that clear understanding, then it's very difficult to communicate anything. So again, when we talk about performance, again, it all comes back to the goal, right? So if we're talking about performance, what we're normally going to measure is we're normally going to measure a combination of the income we've received from an investment and the change in the price of the individual units we own, be they shares or units or whatever, right?
Yep.
And I'll go through some examples in a moment. That can be done in a couple of different ways depending on the story you want to tell. And so, it's not necessarily as simple as it might seem. So, because if you think about it, really, when we talk about performance and we're trying to get that biggest possible number, and that number is income plus whatever the movement in prices are,
Growth,
the movement in prices is generally always going to be a factor greater than the income paid. Okay, so the income paid from a performance, particularly in the short-term perspective, is virtually irrelevant, because it's never going to be big enough to offset big movements in prices. And so if our goal here is to say, well, I want to have the biggest number on my balance sheet and I'm using mark-to-market valuations, i.e. I'm using the market price, if you like, and we'll talk a bit about those different definitions in a moment, but then really all I'm trying to do is boost the price, okay? And so inflating my stock price is always going to be my goal, because that's always going to drive that measure the most. And I'll go through an example in a moment, because I think to illustrate that, there's no better example of that than the tech wreck in the early 2000s, about exactly how that can play out when you kind of get that wrong, right? But if your goal is really, with all of your financial capital, is really to protect that long-term purchasing power, in other words, the sustainability of cash flow over time, then really what you're trying to do is you're trying to almost enhance the minimum potential outcome of that, right? So because all returns are probabilistic, as we predict in the future, they compound, those error bars, if you like, compound. So in reality, what you're trying to do is say, well, if I narrow that potential return band as narrow as possible, then my future worst case scenario is going to be as high as possible, if that makes sense, right? So then my worst case scenario, I'm maximizing the worst case amount of cash flow that I'm going to get over time, right? Now, how I get that cash flow, whether that's, a share of profits paid directly by dividends, or, stock price or unit prices rising by an increase in earnings that are reflected in that price, because it doesn't really matter, as long as what's going to be fundamentally driving that future growth in price is that intrinsic value. That is the value of all those future profits. So in a really simple sense, if I can buy something where the likelihood of future profits being materially higher than they are today is strong for the price that I pay, then that's really kind of what I'm aiming for, right? And that's a very, very different approach to I want to buy something where the price goes up the most. Does that make sense?
Yeah. I think you're looking at growth in the terms of simple is growth versus income.
Yeah, but it's important to look at, when you say growth, right? What do we mean by growth? Do we mean inflation in the price of the unit or the price of the share?
Yeah.
Or do we mean, and there's a number of factors that can drive that, and I'll give a really good example from the dot-com era, I think, to illustrate that. But alternatively, if the cash flow generated from a company, say, continues to go up over time, then the value of those things are going to be more, okay? And so really simple of that is like, well, why does the Australian property prices keep going up? Okay, now we can look at what expands and contracts prices in the short term, but fundamentally rents go up over time. And if rents go up over time, therefore the income generated by property goes up over time. And so in the long term, so will the relative underlying asset price, continue to rise over time.
That's how you work out your yield, isn't it? For purchase price versus income.
Well, your market price versus your income is your current yield, if you like. Yes. So provided the income continues to grow, now the rate of that growth is going to drive the long-term rate of growth. But that's exactly why when we look at long-term income versus long-term growth out of a share market, property market, or any other market, those two lines, they're highly correlated in the long term because they're causally linked, right? But again, if we're looking to say, well, I just want the biggest number on my balance sheet, then waiting for that growth in income is, well, first of all, it's not guaranteed, depending on what it is we're talking about. And second of all, it might be relatively low, or it might be something that had a high possibility that was never realized. But if we want to just pump up the price, and this is where the trading, making money sort of seduction sort of comes in, because the price movements from a capital sense, as I said before, they dwarf, not only in the amount, but also the timing. If the stock goes up a lot in 3 to 6 months, it goes up 10, 20, 30, or 100%, rather than pay a 2 or 3% dividend, well, obviously, that's where it can appear to be. But a really good example of this, I think, is, and most people watching this probably won't even remember, some of them remember the tech boom, but there's one of my favorite examples from them was a company in the US called Priceline.com. So we're not talking about the pharmacies in Australia, we're talking about an American company. And Priceline.com, they basically had a look at the airline market, and they said, hey, there's about 500,000 seats that remain unsold on airlines. So what if we could sell those seats? You know, the airlines, because you know, there's one of the tenets in the airline industry. There's nothing of less value than an empty seat takeoff, right? So they want to kind of fill the plane. So they're looking at that. Okay, marginal cost of that to the airlines next to nothing. If we can sell those seats, we can make a lot of money. There's a lot of seats to be sold. So they launched in April of 1998. And by the end of 1999, they're selling like 1,000 seats a day. So their revenue growth, if you like, their sales growth was quite high. But in the first 6 months, they spent over $20 million just in advertising. They were the fifth or sixth most recognised brand in the US at that point in time. So obviously as this is a tech boom, they launch in April 98, the sales growth is real high. They do an IPO in March of 1999, so only been around a year, at $16, and this gives you a reminder of the froth and bubble at the time. So they launched at $16, they hit 88 on their opening day.
People would be happy. So just explain IPO a bit more.
So initial public offering. So this is a private company that's now listed onto the stock exchange. So they're offering some degree of their stock, not necessarily all of it. In fact, rarely do they offer all of it necessarily straight away, but they're issuing stock onto the market. So you can buy into the IPO. In this case, the IPO price was $16, but it hit a high of $88 on the first day. So a very nice stag profit they're referred to, before sort of settling down to sort of 69. Okay, so that looks like a great investment, right?
Yeah. So just to explain that a bit more, like with the IPO at $16, it's shares on issue via the share price gives you the market cap, which is a term of a business.
Yep.
So that market cap went up by
fourfold.
6 times.
Fourfold, yeah. Fourfold on the settled at fourfold on the open day, but was even higher than that in the intraday trading. Yeah. Now, keeping in mind that float, the venture capital guys and the early investors in that might have paid $1 or $2 a share. So they've already, even to the degree that they realised money at that float or sold out into the market afterwards, which is the way more common scenario, they're selling out at 10 or more times what they've paid in many cases. So, but if you look at the fundamentals of this company, so here's a company that, their revenue growth's grown dramatically in 12 months, okay? But within the first few quarters, they'd lost over $140 million, okay? Because they often had to buy tickets on the open market to cover, so people would go on their site and bid for these empty seats. Yeah. They would then have to go and pay for these, and they were often losing sort of on average about $30 per ticket. So think of this in terms of every time they buy a ticket, someone buys a ticket through Priceline.com, Priceline loses money every time they make a trade, right? So, and some of their competitors were sort of a bit perplexed by this. It reminded me very much at the time, Jerry Harvey was quoted as saying that he didn't understand, Harvey Norman in particular in Australia were going through a similar scenario in retail because there were lots of online auction sites and online discount sites, I know because I was buying off some of them, where you could buy things below cost. Yeah. And Harvey Norman's share price copped a bit of a hammering and they were very much on the pump. And Jerry Harvey at the time was interviewed and said, you don't have an internet strategy. This is the new wave. Everything's changing, moving online. And Jerry Harvey basically said, look, this is going to change. It'll happen. We get that. We're not really sure how to do it yet, so we're going to sit and see. But what I don't understand is I can go to some of these sites and buy things cheaper from them than I can buy them directly from the wholesaler, so directly from the company. So I don't understand how you continue to lose money and how that's a good thing. And Harvey Norman's still around, and certainly the sites I was buying from at the time are most definitely not. So there were some great bargains at the time, but there was a lot of these business models that were based on all we need to do is increase our revenue growth. The share price will go up, and if we can sell out our shares at that higher share price, well then away we go. Or more importantly, we can continue to raise capital at higher prices from the market, so we can continue to fund all these losses by raising more capital. And you can't, obviously, that's not a sustainable business practice. But what it does do is it pumps out. Now, interestingly, if you look at all the early investors in Priceline, they were all out well and truly before the crash in sort of April 2000. So they were never cared about the intrinsic value, never cared about the relative long-term profitability of the company. They were just there to pump the stock price up. And who was left holding the bag? As always, investors were, right? People who were looking at this saying, oh, this must be a great company, it must be growing, it's got all the right...
Because it's gone through,
Yeah. Whereas if I compare that to a company, something you definitely would have heard of, is a company called Colgate-Palmolive, and almost everyone would have at least one of their products in their home. So Colgate-Palmolive's is more what I'd call a consistent dividend paying. Now, this is clearly not recommendation, and none of the things we talk about today are recommendations, but just to give you a sort of contrast, right? So Colgate-Palmolive, the reason I picked them as examples is because they first started paying dividends back in 1895, back when even you and I were young. So
yes.
And so quite famously, they're one of the longest paying dividend stocks in the world. But also, and probably as impressively, is they've now hit 59 years of consecutive increase in dividend payments. Right? So for the last 59 years, their dividends have gone up every single year along the way.
Yeah.
And in fact, to give you a quick example, I went back as far as I could find, but in 1990, the dividend was 5 cents a share, and now it's $1.80, right? So that's a 12% per annum annual increase in dividend payments. So imagine you go out and you buy toothpaste and dishwashing liquid back in 1990, and then every year you get a 12% pay rise all the way through. So obviously,
and the only way they can do that is by increasing their income year on year.
By increasing their profit year on year, correct? Yeah, sustainable profit growth. So not spectacular. You know, you compared to the dot-com era, compared to the Teslas and Netflix and Afterpays and some of these more, let's call them, disruption sort of style stocks. Good solid dividend payer. The calculation of that, through time is, sort of pretty impressive. So,
So even if the price doesn't increase that much, like it has, but, long as they're continuing to pay the dividends and ongoing, you can tell that the business is still performing well, like without looking into the financials of the business itself.
So looking into the sustainability of that in the future is always important, because just because Colgate-Palmolive has done this for 60 years doesn't mean they'll do it next year. So the sustainability, that's important. But again, absolutely, if you're looking for something that says, okay, well, I want to protect my future purchasing power, do I want to look at things that even if I find a way to trade into the price lines of this world, the reality is I always have to get out of those. It's always going to have to take that money and put it somewhere. If I'm not continually trading that and taking some of that profit, like a trader does, then really what I have to do is have to find things that will do that for me, and I use Colgate-Palmolive as an example. So one's not necessarily better or right or wrong than the other one, but obviously two very, very different ways. One can only be used to make money, okay, and recognize that that's the most contested sport in the world, okay? And the other one is just what I would call the patient growing of money, and that is protecting not so much the capital value itself per se, that result comes, but that happens because you're protecting the long-term purchasing power, i.e. the ability to access future cash flow that's likely to be much higher than today. So that's when we're looking for performance, we're looking for what are the factors that might create that long-term outcome. Okay, not what numbers suggest that might be achievable. What are the behaviours? What are the factors? What's the DNA? What's the molecules that will make that happen, if you like, right? So it's that future generation of cash flow is way more important to us than what a particular market price. Because again, if I went back and looked through Colgate-Palmolive's history, there's plenty of times where they were very out of favour. They're boring. They're low growth. They're consumer staples. There's lots of reasons not to own them, and there's also been some times when the share price has been inflated for the opposite sort of reasons. But that market price movement is always going to be a much bigger factor, a much bigger lever in looking at what my short-term performance looks like. And so that's not something that we really want to, that we pay a lot of attention to, because we know how inaccurate those numbers can be. They're not irrelevant, but they're certainly not the main driver. And if they're the main driver of the performance numbers, then we always want to take those performance numbers with a bit of a grain of salt, if that makes sense.
Yeah. So, can you give me some examples of potentially misleading performance? Something that, using the truth to tell lies that you referred to earlier, like if you, analyse data enough, you can get any answer you want. And I think what you're saying there is you just compare it against different things, don't you? So you can get any result you want by comparing two different axes, really.
Well, if you're careful about what you compare, I suppose. So I want to quickly run through one. This is a video we've done in the past, but I'll give another example as well. So I want to look at it in terms of performance tables in particular, because I think they're probably the worst offender, if you like, in terms of they can be used very judiciously to tell stories that aren't necessarily true or aren't proper representations of what it is you're trying to access, right? So the result we're trying to get might be long-term performance, but the question is how is that materially and physically achieved? So I call this a tailored to investment. So here's, again, just looking at this example, we've got two investments here. We've got, your 3, 6, 1 year, 3 year, 5 year performance results. We've got investment 1 or 2. And as you can see, there's not a lot between these. Investment 1, slightly better, slightly worse in 6 months, bit better over 1 year, bit better over 3 year, about the same over 5. So you think, well, there's probably not a lot of difference between these two investments. So, but look, investment 1's done slightly better, you'd probably err towards that. And then the question is, okay, but how was that actually achieved? Like what actually happened with that investment? And what these two graphs show is some of the detail behind that. So you can see essentially what you can see from this is investment 1. So this is the unit price. How is the price of the units moved over time? And you can see investment 2 is a much more steady kind of, just gets there eventually kind of performance, whereas investment 1's a lot more volatile. Okay. And so yes, they might have ended up with the same end result over time, but you can see the ride's been materially different. And most importantly, and this is the graph on the right now, you can see that what I've done here is I've looked at what was the return for the investor, the actual individual investor, depending on which month they invested. Okay, their average annual return, right? So as you can see, there's only been a couple of months, and that was right in the middle with about sort of month 22 through about month 26. They're the only months in that whole period of time where had you invested in investment 1, you would have got a better return than investment 2. Does that make sense?
Yeah.
Every other month, investors in investment 2 would have done better and would have done, in many cases, materially better because of when they invested, because of that relative difference in volatility. So that's really, really important, right? And here's my favorite all-time example. Here I want to talk about the difference between volatility and what that does for investing. So this is the M2. So we're going way back now into, sort of 30 odd years ago. So the M2, when it was further, this is the toll road in Sydney that certainly people in New South Wales will be very familiar with. So M2 is quite an interesting study, I think, because the M2 was part owned by a listed company called Hills Motorway. And it was also owned, the other sort of 50% was owned privately by, I think, AMP and some other institutional investors. So actually that toll road was split into 2 different ways you could be an investor in the toll road. So one is you're investing through Hills Motorway, the listed company, and the other is you're a direct investor, if you like. Okay. So what this first graph looks at is the red line is the revenue. Okay. So you can see, like most toll roads, fantastic, good, compound annual growth rate, pretty steady. And the expenses, which is a blue line, once it's built, the expenses are, relatively contained. So your growth in profitability over time is quite strong. So you'd look at that and you'd say, from an investor's perspective, very high probability of predictable future returns. So that looks like a great investment, okay? Again, depending on price, right? And so you'd think then investing in that wouldn't really make much difference whether you invested via Hills Motorway, the listed company, or whether you were a direct investor. Your return over that period of time realistically should be pretty much the same because you're buying exactly the same asset, right?
Yeah.
And the financial data is obviously extremely transparent. And here's what actually happened. So here's the return profile from Hills Motorway. So you can see that your return in Hills Motorway, this owning the shares in your highest year was sort of 160% in a 12-month period. And there were a number of periods where your returns were negative, even as down as sort of far as sort of minus 30, 35%, I think it was, along the way. So between 95 and 2005, when Hills Motorway was delisted, it generated an annual compound return to 27%. So fantastic return, 27% annual compound return. You'd take that every day of the week, no problem, which is eventually why it was taken over. But your average compound return was 27%. However, annualized volatility was 30. Right? So just again, to understand that just from a mathematical perspective, keep in mind that one standard deviation either side of the average is about 2/3 of the return. and 2 standard deviations either side's about 95% of the return. So what that means is within 2 standard deviations, so 95% of your returns, so add 30 and 30, so add 60. So between 87% and then take off 60, so what's that, minus 33%, 95% of the returns were within that range. So a huge amount of volatility in something that has virtually no volatility in its earnings. Okay,
Yeah,
so
it's
it's
weird. Yeah.
predictable, but because of the trading of that stock, we went returns up to 160 and sort of, minus 40 odd percent sort of thing. So what that shows you is when you take something that is a relatively predictable asset and you divide it, right? So this is what the concept of divisibility.
Yeah.
So now rather than buy the whole toll road, you cut it up into millions and millions of different shares, or if not billions of shares. And so now, because of that divisibility, you now massively increase the liquidity. So your ability to access that asset is now massively increased because you're only accessing a portion of it, okay? Now, if you increase liquidity, by definition and by result, you increase now the volatility. Because now, the more liquid something is, the more it will be treated as a commodity. The more it will be treated as something that can be bought and sold as a thing in itself, detached from the underlying thing that has an intrinsic value. Because you don't care about the intrinsic value if you're trading it. You just care about, can I sell it for more than I bought it for in the relatively short term? And you get this extreme volatility in an asset that's about as solid and predictable and reliable, which is why, major pension funds and large super funds all around the world have bought up, airports and toll roads and those sorts of things in recent years because of the predictability and growth in earnings. So that just shows you that, again, going back to what we were talking about earlier, is if your approach is trading, right, it's a fundamentally different thing to if your approach is investing. And just because something is volatile, and Hills Motorway being my favourite example of all time, doesn't necessarily mean that's a reflection of the underlying asset itself, because in many cases, it's purely a function of the liquidity.
So that's sort of, in other terms, that it's spoken about things like price to earnings. PE ratios is a common term that people would hear, but that's what you're talking about, isn't it? So the price of the share is going up and down, but the earnings are pretty much staying the same.
Yeah, so that's a great example. So in this graph, this sort of breaks it. This is a little bit busy, so I'll sort of talk through it, but this is exactly that scenario, right? So let's start with the grey. So you see this sort of grey shaded area, which is, sort of basically along the bottom here. This is the contribution to return. Okay, so the black line here is our 12-month rolling return, so each rolling 12-month period. Yeah. And then the other colours are the contribution to that return. So you can see dividends, as you see, they're basically sold all the way through. Okay? Yeah. And so dividends really don't change much year to year. In fact, the standard deviations of dividends is about 1% per annum. So dividends average about 4.5%, excluding franking credits, with a standard deviation of about 1. So in other words, dividends are really predictable on whole from markets, generally speaking. But then what drives the price, and we're talking about that if it's the share price now, or the unit price moving a lot, is the two things that drive that particularly are change in earnings, so earnings per share growth, and that in this graph it's the light blue. So as you can see, the light blue is companies making more money. Yeah. So they're actually increasing their earnings, and as a result of that, of course you expect the prices to rise as a result. But the other important part of that is what we call PE, which what you were referring to is PE expansion or contraction. And think of PE expansion or contraction, i.e. the PE ratios going up or down. That's to do with an expectation of the change in future earnings, right? So if we've got a company that normally is valued at, say, 15 times earnings, but their earnings growth has really ramped up. They've really hit got a new product or hit a new market or new division or something about them, or there's new demand. Yeah. There are, like Zoom, coming into the pandemic, was positioned greatly, to take advantage of that. So you can see this huge increase in earnings per share. And the question is that earnings per share a fundamental change? I.e., will that now grow their earnings at a higher rate than they have historically? And so not only do those earnings increase valuations, but rather than being valued at 15 times earnings, it really should now be valued at 20. So you get a doubling of earnings, that's a doubling of share price, and then you get an expansion of that PE ratio can mean another sort of 40-50% increase in valuation. Okay?
Yeah.
So we talked a bit about that differential when we talked about interest rates and the impact they can have on valuations. So what this dark blue is, it's showing, well, the prices have gone up because of because of the expectations of earnings. So you can see coming into GFC, we really strong performance, a little bit of expansion because of the expectation that this will continue to be really good. But then you can see here, and this is the beginning, this is the GFC just starting to take off in late 2007, early 2008. You can see here earnings expectations plummet. So earnings continue actually to be quite positive through this period, but the expectation is that they're going to be a lot worse. And in fact, they were. Okay. Now, then you can see before the earnings actually turn around, the earnings expectations start to leap up again. Okay, because again, the market is forward looking. It's saying, okay, well, what's it going to be like in the future? And not surprisingly, it overshoots. The earnings eventually catch up. Okay, but just as the earnings catch up, the earnings expectation drop, and so on and so on. And so we see this sort of like the combination of, there's the actual dividends, which are always the least significant, or pretty much the least significant. Then you have the actual earnings growth itself, be it positive or negative. And then you see the expectation. So you get these huge amplifications in terms of what the market price will be relative to the intrinsic value, because the market's always trying to catch up to that. That's why we get this huge volatility in price. Now, if we get a huge volatility in price, one point in time, then if we were to look at this point here, this sort of peak in terms of performance, and look at that and say, well, the market price is a proper reflection of the value of the market. Well, it clearly isn't, because earnings expectations are already diving at that point. Yeah. Okay, so we know that performance is going to continue to drop as a result of that, and of course it does. So looking at a particular point in time, a snapshot, just because it happens to be June 30, and that's when the super fund's reporting, or you're doing your annual returns, and looking at that in isolation and not contextually to say, oh, well, that was your return for the 12 months, therefore your performance is good or bad relative to a portfolio that is in shares that are moving, their earnings are moving counter-cyclical, for example. Because again, this is an example of the total market, but within that, or in this case, the top 100, within that, you'll find different companies at different stages of that cycle, right? So this is why when we look at performance graphs and performance tables in particular, we take that with a grain of salt, because what we're trying to do there is we're trying to make sure that we look at what the underlying components of that and drivers of that are from a relative basis. I want to give you one more example in terms of performance tables, because I think this will help illustrate similar to that table of investments before. So in this particular table here, I'm going to look at, again, I've just constructed a performance table here that says, okay, well, I invested $10,000, and my return over a 7-year period, I've now got sort of 18,000, nearly 18,400, and here's my return. My performance table says my 6-month return's 30%, my 1-year return's 35, 2 years is 15, 3 is 9.5, 5 is 8, or nearly 9, and 7 is 9%. Yeah. So again, looking at this, you think, what a good investment this must be. Consistent performance all the way through that period of time, and its return 9% over 7 years looks fantastic. You'd say, on the surface of it, that seems like a reasonably good investment. Now, the problem with that is if I expand this out a little bit, and obviously this is very close to a real life example. I didn't have to game this very much. If I expand this out, what you'll see is the years that were hidden in this case, so years 4 and 6, the performance sort of drops a fair bit. And if I expand this out to give it sort of the full sort of context, this graph here is looking for the period return specifically, and then this column here, column J, is then looking at the annual return for that particular year. So in this particular case, we've actually got an investment that early on in the 7-year period, in the first year, it did nearly 50%, had a great start. Okay, then it retreated sort of 20, and then it sort of came back 20, and then had a small negative, smaller negative, small negative. Yeah. Then it started to pick up again, and it had another great year, or had a great 6 months in the last 6 months. Now, if I'm the marketing department of this particular fund, let's pretend this is an investment product now, or a super fund, then I'm looking for that cycle. I'm looking for that 7-year period. I'm looking for that sweet spot where things have lined up, where I can print a performance table that says, ignoring these two here, I can now give you the truth. This is 100% accurate,
Yeah.
right? This is what happened in this fund. I'm not going to get in trouble from ASIC. I might when they look into, if they were to look in the detail enough, and there's too many products for them to do that. But on the surface of it, looks like I'm a good investor. But in reality, if I didn't invest at the very beginning, so here's my gain per year. You can see good gain in the first year. Then I lost and regained. Then a little loss, little loss, little loss. And in fact, so 6 years down the track, I haven't made any money. Like if I came in year 2, 6 years down the track, I'm still $800 underwater on my 10,000. Do you really think I would stick around for that 6-month bang? You know, do you really think investors are going to, and if we look at the investor behaviour, which we won't do today, we've looked at that in other videos, but investors just do not hang around, or people who are using performance tables in particular to look at, because they're going to see very different performance tables along the way. Okay, but from a positioning perspective, if I was the marketing department of this particular product, I would be out in every major magazine at the moment saying, look at our long-term performance. You know, you really should take a look at this fund.
And that's what gets people seduced or talking about it and so on, yeah.
And again, you know, they're not telling any lies here in the sense that, you know, all that data is 100% true. Okay, but depending on the nature of the graph and the timing of things, and volatility is a wonderful thing to help create this, is that you can get that, if you time your messages right, you can tell things that are true, but are not what I would call proper representations of what it is you're trying to do. So in that sense, you know, and that's one of the reasons why it's important to recognize that market price is almost always a poor reflection of intrinsic value. Yeah. Right? And you can see this probably most easily if you look at, because market price is what the last parcel of shares sold for, which might only be
someone's willing to pay
thousands or tens of thousands of dollars worth of $1 billion or $100 billion company.
Yeah.
Okay. So it's the most motivated seller. Okay. So in that sense, what we're trying to do here is we're trying to say, well, that's not irrelevant, because if we want to understand that relative to intrinsic value, but if we're looking for intrinsic value, so if I wanted to own the whole company, I want to launch a takeover bid now for a company, that's why takeover premiums are always 30 to 40%, right? Because now I have to actually pay at least intrinsic value because I'm buying the whole thing and I need all the shareholders to participate. Plus I probably have to pay them a bit of a premium as well, maybe another 10% or so, because they're now going to forego the opportunity for it to be better than they potentially thought. So takeover offers are always a much better indication of the real intrinsic value of a company than market price. But because takeover offers don't happen every day, market value is what we have. But using market value to determine valuation can be a very dangerous thing to do.
Yeah, I know what you mean. So what a company's share price is, it doesn't necessarily mean that the whole company is valued at that market cap. Yeah.
Yeah, so it might be useful then to look at a couple of different ways performance might be presented, and some of the sort of tricks that particularly the finance industry has been known to use, because there's a couple of different ways. There's what we call internal rate of return, which is certainly what we use as a performance measure because it's the most accurate. I'll talk about that one at the end. And then there's sort of a standard return versus compound and sort of standard profit and loss sort of scenario. So let's start with what I think is the worst offender and probably the most common one, and that's particularly used by stockbrokers, and that's sort of the profit and loss example. So in this example, so I want to look at, you know, we've got again just a small mythical portfolio here. We've got 5 stocks. So we put $100,000 into each of these stocks, and at a particular point in time, they've got varying market values. One's dropped to 76, one's up to 110, and there's sort of various valuations along the way. So this is normally the data that you would get from a broker report, for example. So here's your cost base, here's your gain or loss, here's your market value, and here's your yield. Now, why they put yield there, I'll explain that in a sec, but it's really irrelevant for the purposes of what this information's trying to get you to focus on. As human beings, we generally react to losses twice as severely as we react to gains or potential wins. So this is all about the red. Okay, so if we look at this portfolio, clearly stock E is not performing. Okay.
No.
Now, what I mean by that is the price I paid for it versus the price it is now, it's dropped. However, the question is, why has that happened? Did I just get in a bit early and I got in before the rebound's happening? Did I get in and there was some sort of move in general market sentiment? This doesn't tell me anything other than the yield is now high. So I might have bought into it because it was a high yield and the yield's gone up because the dividend hasn't changed but the price has gone down. Now that might mean that that's because profits in the future are going to be lower and therefore the yield will drop as well. And that would be a reason to get out. Or it might just be a case of the market is saying, hey, this is Commonwealth Bank in the GFC and no one wants to invest in banks at the moment, even though it turns out, that banks, Australian banks in particular, remained very profitable through that period. So we don't have any context around this number, but that number looks bad. So as a presenter of this information to someone, if I want to say, well, I want to make the next meeting in 6 or 12 months' time go a bit easier, all I do is I just recycle this portfolio. So what I do is I say, well, look, E's not performing. Let's get rid of that, okay? And I'm also going to sell A because I think it's had its run. It hasn't done as well as we thought. We're going to rotate out of A. And so, 6 or 12 months down the track, we come back and we've now got F and G in the portfolio, replacing A and E.
E, yeah.
But here's what's happened. We went from a portfolio that had 508, was worth 508,000, that I'd invested 500 in. Now, though, we've just slightly different movement in prices. We can now see there's no red in the portfolio. So that's good. Portfolio is doing well. At least the appearance of it doing well. Again, I have no context to actually make that decision. But just on the face of the information presented, which is all I have here, it appears that this portfolio has done a lot better than, or is doing a lot better than the portfolio before. Okay, and because now you can see that I have, everything's black, everything's a gain, but you can actually see that stock C, rather than being 123 like it was before, is now 115. So it's actually down.
Yeah, it's gone.
B's up a little bit, D's up a little bit. But overall, my portfolio has only gone up $1,000 in that period, okay? But I'm looking at an unrealised gain of 23.5, whereas my unrealised gain before was only 8.5. And all that's happened is when I've rotated out of A, my cost base has gone from 100 to 110 because I sold A at 110. But most importantly, my cost base for G is my sale price for E. So you can see I paid 76,000 for E. The loss that I incurred on E has now essentially disappeared from my reporting.
Yes.
Okay.
So if you had if you had covered both periods with the loss that you've taken in the first 2 years, the capital gain would be $14,000 less than that. You've already realised.
Correct. Yeah. My gain since inception, if I were to run that report.
Yeah.
But here's why this is important to understand is because if you run this now 100 times through a portfolio as things change over time, as people add money to a portfolio, as people subtract money to the portfolio, as tax credits come in and depreciation gets considered in terms of cost bases, and there's a whole myriad of things. I've done an extremely simple example here just to illustrate it, but all of these numbers change. And they don't necessarily change in a way that is truthful in terms of trying to measure performance. And what this doesn't have, the most important factor here, this does not tell you time. Okay.
And if you had one of those reports from the start, it wouldn't have the one that was sold. It only have the ones you're holding. So
correct. It wouldn't. Correct. So it might tell me, if it goes back far enough and is truthful enough, might tell me how much I originally invested. But the advantage of the share market is it grows over time. So I've got this natural, so historically we've seen examples of portfolios that have, they've grown substantially over a long period of time, especially when we deal with deceased estates. And we find portfolios, but what we routinely find in deceased estates is, first of all, they've never kept up with the market. Almost never have I found a portfolio where someone's invested for 20, 30, 40 years and they've kept up with the market. That's extremely rare, I find, in direct share portfolios. But what I always find is 60 to 80% of the gains in the portfolios are in 2 or 3 stocks. And in fact, that's a function of the market in general. If you look at the market over the long term, almost no companies provide substantial net performance to the index. Right? It's always a very small concentration. Many disappear, most do nothing or go backwards. It's a bit of Pareto principle, right? But it's really important to understand that that how information is presented to you, again, this is all factually correct. It doesn't tell you time. It doesn't tell you that maybe stock C, I might have owned stock C for 10 years. And so, yes, it's up 15,000, but over 10 years. Whereas some of these other stocks I might have owned for a year or two. So there's lots of things that aren't contained, lots of context, if you like, that isn't contained in this portfolio. So that's why we use internal rate of return, right? So, because what internal rate of return does is it tells you what's the return on the money that was invested during the period of time. So it takes into account the fact that you invested 100,000, it's doubled, but then you added $1 million, right? So you've now invested 1.1 and you got 1.2. So did you make 10% or did you make 100%? Well, internal rate of return will tell you made 100% because you doubled the 100, the million came in at the end.
Yeah.
Okay, it's things like that. So that's the best, that's by far the best example or why we use those sort of measures. And look, the whole point, I suppose, is you've got to get into the detail to really understand what's going on when it comes to performance.
Yeah, so there's the standard annual reports. Yeah, most people will just take them for granted because it shows you, like you said, Mark, what it was then, what it is now. This is your return, but it's probably people aren't going to go much further into that sort of stuff. So you expect the advisor to tell them.
Well, to the degree that they have advice, right? Because it's really important to understand the context around that it's a mark to mark and a very specific point in time and very arbitrary, right? So, why is June 30 more significant than February the 15th if you're looking at it from a performance perspective? So in that sense, it's really important to always understand contextually, and just because something looks like it did better through a particular period of time, that may not even remotely be the case, just because a particular number may seem to be higher, even if you are comparing actual measurements that are the same.
So, got a question for you just off there. So, managed fund, okay, pays a distribution on the 31st of December of $3 for each unit. So then the next day, the unit value decreases by $3. So it doesn't really matter if you bought the share prior to that day or after in reality, because you're getting the dividend drop in the value of the asset.
Yeah, correct. So, and the same in theory, the same for a share going ex-dividend. So, provided there's been no actual share price movement, your example is exactly right. Yeah. However, it can matter depending on tax position. So, for example, if I'm someone on a very high tax rate and don't want the income, I may be better off selling it and realising the gain, realising that $3 as a gain, and then buying back in the next day and setting a lower cost base, if that makes sense. Or buying a different asset or something like that. So yes, it doesn't.
Yeah, it's a lot of tricks to it, though, isn't there?
There is,
That's
definitely.
what I was getting at now.
Yep.
So, alrighty, let's have a look at that's a great background, I think, and some important tips to what to look out for. But what do you actually look for then?
Okay,
when this comes up, what should people look for? Yeah.
So probably the main thing we're looking for, I guess, is a few sort of important questions that we're trying to answer when it comes to checking an investment manager or an investment sort of process. First thing, is there a system? Because surprisingly, there in a lot of cases there aren't. Right? We don't trust people; we do trust systems. Okay, so do you have a system? Is it really well documented? Is it easily and consistently explained? If you can't explain it really simply and consistently and provide examples that demonstrate its execution, then you don't really have a system, right? So, and then we want to understand, well, does it work? So where's the evidence of that system being deployed consistently and it works? Like what environments, what constraints are there? It won't work if this is happening or these sort of scenarios, or where will it be under stress? And then most importantly, do you follow it? Okay. So, and is there a sort of behaviour of ruthless consistency and adherence to it? So when everything's going against you, when everything makes you look bad on a relative or absolute turn or whatever, like or your system threw up results that were wrong and you bought something and lost money, what's your reaction to that, right? Because you can't avoid things going wrong, and be they things not really going wrong, it's just the market not rewarding your perspective at a particular point in time. That's very common. Or it just turns out that your system had a flaw, okay, and so you bought something you shouldn't have and it went down. Or maybe it didn't have a flaw, just something happened, the war in Ukraine or coronavirus or something from left field sort of came along. So what impact did that have and how did you react to that? That's really what we're looking for. And probably the best way we use to measure that is what we call attribution, right? And you can see that from those performance tables we looked at before. Were you lucky a couple of times? Either because you got something really right or you avoided something really wrong? Okay, and that's really behind your entire history of performance? Or is there lots of little bits that you seem to just consistently get right, in terms of attribution? And how do you react relative to other pressures? Whether it's mark-to-market performance or peers, do you tend to
Yep.
change your approach based on those pressures? Obviously, they're danger signs for us. So here's an example. So I've taken this from a particular fund. So here's the sort of thing that we'd be looking for most managers. So this is just a snapshot of point in time, looking at this particular fund and some pretty interesting metrics relative to the market. So at this particular point in time, you can see this fund. So its net earnings yield, okay, so the earnings generated based on the value of the portfolio was 9% compared to a market of 6.5%. That's good. We want that. That's what we want. In other words, what we own is probably undervalued relative to the broader market. Dividend yield slightly higher, not necessarily that big an issue for us, but it's nice to know. Price to book, that just basically says this is undervalued relative. We'd expect to see that. And also enterprise value to sales. In other words, is this likely to be a high growth, relatively speculative? So they're not the only measures, but you can see these measures would be consistent with a manager who is trying to buy companies that are relatively undervalued. Now, if we don't see this in a manager who has an approach like that, then we'd want some really good reasons why, right?
Yeah.
So they're the sorts of things, they're sort of checks. Things like, for example, this is this is a research we did back in 2015. I wanted to do something old in a fund we don't currently recommend. Again, because this is a recommendation, but this is an analysis we did back in 2015. So this is looking at this particular fund's perpetual value Australian share fund, and we're looking here at its consistency of returns. Okay, so how consistent in up and down period is it? Does it make returns? That's one of the things we would look at. This one here is looking more at sort of attribution. So in attribution, we're looking at this is a 3-month rolling excess return. So this is relative to the market, okay, which may or may not be appropriate depending on the fund, but is still a useful measure to look at relative consistency. Is the market driving their result, or are they? If they're never moving, if they say we're index unaware and we don't care about the market, yet they never deviate far from it, that would be a sign that they probably aren't. So, and what we're looking for here is, do they, again, get lucky? There are periods of lots of, short bursts of outperformance followed by longer periods of underperformance. We want to see that consistently because our clients will be investing in this fund at all sorts of different periods of time. We don't want to be in a situation where everyone invested at this point in time is going great and everyone else is really sort of struggling. So attribution's an important one. This is the frequency of distribution. So in this, the further to the right, the bigger the return. So again, is it lots of little outperformances or is it one or two big, hit some home runs? And then this is the historical income growth. So again, this is another measurement because again, what we're looking for here is, does the portfolio consistently generate higher net cash flow? Is a key indicator is, yes, they are buying the right sort of companies, for example. So this is by no means comprehensive, but I wanted to give you a couple of examples of the sorts of things that we might look at when we're, going to decide to use a particular fund manager or investment strategy, is we're looking at that, what behaviour, okay, and what system is likely to work to deliver that kind of result.
So, I think a classic example of a company like that is CSL, the darling of has been really hard to read when you look at P&E, but it just has kept growing over the years, hasn't it? So that's a hard one to read, really. But
well, it is relative to value, right? Because there's been plenty of times where CSL's PE's expanded faster than its expected future earnings and vice versa. So again, CSL is a great long-term stock, but again, owning that stock at the right time, or at least proportionately the right time, maybe a bit more and a bit less as opposed to all or nothing. But that's a sort of how would an investment manager who invested in CSL, how would they change their portfolio weightings over time, would be a really good indicator to us about how well they executed on their particular system.
Yeah. All right. That's fantastic. I think that really broken it down for us, and probably a lot more questions could come out of it, I think. So it's something that I'm sure I want to, take a deeper look at, and anyone out there wants to take a deeper look, it's something we could just get in touch with us, and What's our email address again? Yep.
moneymondays@completewealth.com.au.
Yeah,
fix
send
that.
an email in if you're out there and you just got a query on any of this sort of stuff, or if you'd like us to talk about anything in particular. But you got anything else to add, Matt? Or are you
I think
happy with that?
that's probably enough for today, Marcus. I wanted to go into a fair bit of detail with some of those so that people can really see what it is we're actually talking about. But obviously, always happy to go into more
I think it's
detail or different angles.
Yeah, I think you're exactly right. Performance, you go and see someone, they give you a table, yeah, I believe it. Whereas there's a lot more to it, yeah, than what you should be looking at, especially past history and future history. Like, yeah, you might have been in something that was done really well for the last 12 months, like plastic gloves, but they mightn't do as well in the next 12 months and that sort of thing. And yeah, it's no, excellent. All right, well, we'll sign off from Money Mondays this week, and we'll be back again in the near future with another topic. Bye now.